Good morning, ladies and gentlemen, and welcome to MOL's Online Capital Markets Day today. My name is Robert Réti. I'm heading Investor Relations and ESG at MOL Group. And as you have noticed, and you got used to this by now, this is a slightly different format compared to previous years, but our purpose is the same today. We try to make sure that this is going to be a useful day for all of you who join this event. We may not always like this digital online world, but at least we see two distinct benefits of this format. We could certainly extend our geographical reach. So not only we are having now participants across several countries, but even several continents, which we are very happy about. And secondly, we also use this online platform to stream this event internally. So we have a couple of hundred MOL employees across several operating countries who are watching this event, and we would like to grab this opportunity to welcome them as well. Before we start, a few technical things, a few important technical things. The first one is health and safety, which is probably the most important. Given we are in the middle of a pandemic and most of you probably sitting at home in home office, you may be wondering that what these guys are doing here on a stage or stage-like something, wearing no masks. I can assure you that as before, we take the preventive measures very, very seriously. What happened before this event, all the internal and external participants went through PCR testing earlier this week. And then both yesterday for the brief technical rehearsal and for today's main event, we did additional antigen testing, and only those tested negatively could enter the meeting room where we are today. And in fact, testing has always been an integral part of our defense mechanism. I can share this information with you that since the very beginning of the pandemic, we performed more than 100,000 PCR and antigen tests within MOL, and this was actually an instrumental thing to achieve the fact that there was no mass infection within our operating sites or in our offices. The second thing is about our agenda today. So very, very shortly, you will be hearing presentations from our senior management. We have four managers today presenting to you: József Simola, the Group Chief Financial Officer, and then the three segments head, Gabriel Szabó from Downstream, Péter Ratatics from Consumer Services, and Dr. Berislav Gasó from Upstream. After this is going to be roughly an hour or hour and a half, and after that we will have the usual Q&A session in a usual format, similarly to our quarterly calls. We will ask you to use the raise your hand functionality in Microsoft Teams to indicate your interest to ask a question. Finally, again, a usual request that I kindly ask all of you to stay muted during the presentation, so keep your mic muted until the Q&A session and until if and when you want to ask a question. And finally, very finally, I would like to draw your attention to the usual disclaimer or cautionary statement on slide 2 in this presentation about forward-looking statements. Thank you very much, and let's start the presentation. I would like to ask now József Simola to start his presentation.
Thank you, Robert, and good morning, ladies and gentlemen. Thinking back, actually, more than 4 years ago when we launched our strategy in London at the Capital Market Day, and more actually about the meetings after that, I probably have like two feelings. One is that I think we got a lot of positive attention and feedback for that time for our strategy in terms of being it new, maybe even positively radical. But I also remember many meetings with investors and analysts where lots of questions were raised along the lines that are those things are really your most important priority? And sometimes the feeling of isn't it a bit premature, I think, was in the air of those meetings. For me, the thing what changed that this, I think, question of is it premature is clearly not in the air anymore. The directions what we set proved to be the right direction, and I think it's very much very clear industry reality today. All these topics we started to address in our strategy MOL 2030 in 2016. In the first part of the presentation, I like to recap a bit what happened in the last 4 years and kind of lead you through at a very high level from the start and where is the direction changed and where remained the same in the last 4 years. Maybe starting what is and what was the original strategy. And as I said, it's clear for me now that we set the right directions in 2016. As you remember, the base premise of the strategy was that fuel consumption in the region is going to decline sometime in the future. 2030 was a date where it potentially, or by that date potentially, will be already happen. And based on this, we have to start working on a transformation, essentially in all of our businesses. That was clear that in the downstream business, where we were actually a refining company, one of the largest in Central Eastern Europe with some petrochemical operations attached. We have to start moving out again in terms of longer term time horizon from the fuel and move into the petrochemicals because that's where our future business lies. Parallel to this, we had to change the paradigm, which we did successfully, that fuel stations are just outlet for the refinery. And we already proved in the last couple of years that this is much more than that, with visible results in our fresh corner shop for the customer experience, and what's very dear to me, with very visible results in the bottom line and in the EBITDA. In the upstream business, it was clear that there is no real opportunities for reserve replacement in CE. So we have to move out of the region and look for reserve replacement opportunities outside of the region. And actually, we did successfully complete a sizable acquisition with Esg in Azerbaijan. And in terms of the back office transformation and moving into a digital organization, we also made visible progress here, which unfortunately was shock tested beginning of last year with the COVID, but fortunately it worked. You will hear a much deeper review when we go into the business deep dives. But continuing the story, let me go through the milestones. And I actually will not go through the milestones. You will hear again more about this later on. For me, the two takeaways are that, yes, we did achieve not everything, but I think generally everything what we wanted to achieve. And these are very important operational and financial results for us and for our shareholders. But just as importantly, for me, they represent a journey, a train in motion, a trajectory. So these are for me not just past results, but also show a starting point for the future, where we are and how our organization is moving ahead. Now, if you look at the dynamics of the whole situation, and I started with this, that 4 years ago, I think there was a sense in the air that, yeah, maybe the perfect storm is coming for the industry and for us, but I think the general view was, yes, the storm is maybe coming, but change is not imminent. And the feeling I think we had, and we are definitely moving out of this, very much described with this Bill Gates quote, that when we think about change, we generally underestimate what's going to happen in a decade, but we overestimate what's going to happen in 2 or 3 years' time. And I think this is where we are now, actually in between 2 and 3 years and a decade. And I very much expect that all the kind of underlying factors are there, with a very clear acceleration coming from the COVID. In terms of generally, I think, a lower expectations for margins in the hydrocarbon industry, and a clear political and financial willingness in the European Union to actually finance this upcoming green transformation. So I think this is real. So it's not like, is it premature? No, this is real. We started this and we want to continue down on this journey. So what remained unchanged, and what is the additional focus? Clearly unchanged that we anticipate and believe that fuel consumption will decrease in the region. So we have to keep our investments into the petrochemicals and moving out of the fuel business and moving into and moving deeper into the petrochemical business. Consumer focus, that's also the cornerstone, what we said, and I think cornerstone for the future. We definitely want to continue that direction. Where is the additional focus coming from? As I mentioned, acceleration, especially coming from the COVID. And I think we are hitting the steep part of the S-curve in this acceleration process. And in terms of what happened last 4 years and what's going to happen next 4 years, we expect much more and much radical changes coming up, hence the acceleration on our side as well. In the update of the strategy, we put in explicit CO2 and sustainability targets, because if we don't set targets, we cannot achieve them, and I think that's clearly part of the requirements today and what we intend to do. And one more important new thing that in the next 5 years, we already earmarked a significant Capex investment into a low-carbon circular economy, essentially going further in our thinking from 4 years ago, that we want to move into petrochemicals, but it's not just petrochemicals. Beyond that, it's the low-carbon circular and sustainable economy where we intend to become a key player in the CE region. We try to visualize how to think about our strategy, and the 3 or 4 kind of buzzwords or key thoughts I think where it's centered around is consumer is also visually on the top, because consumer is king, and that's the cornerstone and the unchanged direction what we have. Sustainable fuels coming from the premise that yes, fuels are associated with CO2, but phasing out, it's not going to happen in Hungary, in Europe, or in the world overnight or in a year. These are factors outside of us, and our job in this transition to make sure that we make the transition out of the fuel as much sustainable as possible, and I think that's a big task for us and for the industry. And circular economy, as I mentioned, the extension or going deeper into the idea what's next after petrochemicals is clearly recycling, low carbon, circular and sustainable industries and investments we intend to make. What's the meat on the bone? A couple of ideas just showing here, partly already existing, partly in planning. Again, you will hear more details in the business deep dives in the coming minutes. Briefly about, I mentioned that ESG and CO2 is an important thing, and when we think about sustainability for our industry, it's clearly CO2 is the #1 issue, and we explicitly addressing this with numerical targets. So we intend to reduce scope 1 and 2 emissions by 2030 by 30%. Coming from a targeted 20% decrease in the downstream, and from a targeted net zero emission in consumer services and upstream. And as I said, thinking about the future, and when we think future, that's Capex for the CFO, we intend to align that 50% of our Capex by 2030 should be EU taxonomy aligned, i.e. green, and we have an aspiration for 100% by 2050. CO2 is important, but clearly we shouldn't and don't want to forget all the other important stakeholders matter. When we think about climate and environment, it's for industry, it's not just CO2, it's waste management and other things. Health and safety is a traditional focus of us and is going to remain the same, and clearly we want to continue make progress in the people and communities and in the integrity and transparency dimension. Last but not least, a bit of an advertising, and I really don't want to go into the details of the external recognitions, what we received on this ESG journey, but I like to kind of draw the parallel to the milestones, what we achieved business-wise. I think those external feedbacks, positive feedbacks, of course, important reinforcements for us. But it's really for me represent the proof that we are on this journey with good results, and we definitely want to push further ahead. That was a short overview on my side. We will go into the business deep dives. So let me hand over the floor to Gabriel Szabó, head of our downstream division.
So good morning, ladies and gentlemen. Let me continue with the downstream part. I would start with the two basic learnings we have from 2020. First learning for downstream is that the swing towards the carbon neutral world and the carbon neutral Europe is going to speed up. The other learning is that it was rather an in-house experience that we learned how to operate our assets with 20% demand drop. I mean, in general, waiting for the demand to fall is leaving it far too late. So once we go back and we see our 2016 strategy and the changes we are going to promote today, so we see that the 2030 strategy is still valid. I would just rephrase it that the trajectory of this strategy gets a spin of sustainability, and also we are going to focus on the speed of the transformation itself. Once we take the scorecard of the in 2016 promised goals, I would proudly inform you that we delivered more than $140 million efficiency improvements. We also started a polyol project, and for today we delivered 76% of accomplishment. But I have to admit that within the transformation we expected faster pace. So in our strategy we are trying to answer the question as how to integrate sustainability, how to reduce the CO2 emissions, how to invest effectively, and of course, how to mobilize extra resources needed for this transformation. So, all valid questions, aren't they? And I'm pretty sure that I just raised your attention to our revisited strategy. So, in terms of sustainability, we are tackling it from two perspectives. One is the circular economy, and we believe that this is the part of the answer to the question. And we see a great opportunity in circular economy. The other is the CO2 reduction, where we pledge ourselves to deliver 20% of saving of CO2 Scope 1, Scope 2 emissions. In terms of the transformation, we put together a modular roadmap with the transformation project in the amount of $4.5 billion. And you will see that we intend to invest in two major blocks, the transformation, and we aim to convert up to 2 million tons of fossil fuel to the valuable chemicals. Before discussing the strategy in details, let's take our thoughts on a walk to 2050. So we did this wandering with the team, and we came with the vision of the downstream, where we say that we are the European champion in sustainable chemicals. We are powering mobility with ambition to reduce carbon footprint and striving to reach net zero emission. We also thought over what are the basic success factors of it. Partly we build on the competitive advantage we are having today, but also we take into consideration the call of society for sustainability. So we aim to operate our traditional assets, but of course with the reduced carbon footprint or emission footprint in general. We think that the part of the answer for sustainability question is the circular economy, which will save resources, material, energy, and at the end of the day also enhance productivity. We aim to drive all the heat, all the power systems with the green energy. And of course, we would like to elevate our current cost leadership, competitive advantage to even higher level. So on the next slide, you can see how we reimagine our industrial operation. So you can see that beside of the traditional feedstock as crude oil, as natural gas, we also calculate with the waste, we calculate with the green energy. And then, as a part of circular economy, we are going to produce a really compelling portfolio of our products as biofuels, green or even, blue or even green hydrogen, biogas, electricity, recycling polymers, and also chemicals based on waste. Now, let me elaborate on the strategy itself. We have 4 basic pillars within the downstream strategy. This is the efficiency and profitability, fuel transformation, sustainability, and value chain extension. I can assure you that behind all of these pillars there are massive data there. So starting with efficiency. Efficiency, we are aiming from 3 angles. First one, that we would like to harvest the market. So we would like to defend our market share and profitability on our core markets. We would like to keep our position in the first quartile of net cash margin with our 2 refineries. And with completion of the DCU in Rijeka, we believe that we will raise the bar higher in margin generation in Croatia as well. We would like to minimize energy consumption. We aim to invest roughly $50 million for this field annually. And I have to admit that the energy savings are not just the cost saving, but this is the progressive way how to achieve saving on CO2 emissions as well. And of course, unlock the efficiency. So within efficiency, we commit ourselves to deliver $150 million coming from productivity, coming from maintenance, in general from our fixed cost base. Speaking about the transformation itself, so this is the most interesting part. So we screened dozens of technologies, and we shortlisted 3 ones. And we aim this year to submit the FEL1 document, which means front-end loading document. And we believe that we will start with the feasibility studies for the first investment, where we plan to convert even 1 million tons of fossil fuel to valuable chemicals. And the price tag of this investment is around $1 billion. Based on the experience we learned from the first transformation block, we would like to launch another one in 2025 with even a more massive investment of up to $1.5 billion, converting up to 1.3 million tons of fossil fuel to valuable chemicals. Next pillar, an important one, is sustainability. I already shared with you our pledge for the 20% Scope 1, Scope 2 CO2 reduction. So we have really a content behind it. Of course, what I mentioned, this is the progressive way of reaching the savings via energy savings, which will add roughly 0.4 million tons CO2 savings. And the other is, together with my colleague Berislav Gasho from the upstream division, we are discussing the options or the possibilities for carbon capture and storage, where we aim to save 1.3 million tons of CO2, starting with our hydrogen units and getting the blue hydrogen. In terms of the circular economy, we see a huge potential there. So coming from the advanced biofuel, which we will see later in 2 blocks, building up to biorefineries, then waste to chemicals, where we are currently revisiting the technologies. And of course, this is the polymer recycling, all the chemical one, the mechanical one, and of course, solvent-based. On the next slide, you can see the nice pictures of our polyo project, so the huge investments and the major one in the value chain extension. I have to admit that the Capex discipline prompted us to deprioritize big tickets diversification investments for now. So we pushed rather the fossil fuel transformation project, and we aim to invest roughly $300 million for the mid-small size projects at the metathesis, recycling, and compounding. So on the next slide, graphically, we would like to show you this modular, transparent, and traceable roadmap where we are aiming to invest $4.5 billion. I would like to raise your attention for the green blocks where you can see all the sustainable projects, but of course, we should also focus on the two big step changes in the fossil fuel transition to chemicals, which is one to be started up in 2027 and the other in 2030. So of course that you can ask, okay, so far very compelling, but how are you going to finance it? And this is the last slide, summing up our EBITDA generation potential. So from the current $750 million we delivered in CCS EBITDA last year, we are going to achieve about 1.2. So in 5 years period, more than $5 billion. So for discretionary cash flow, we have around $3 billion. From this, we would like to accomplish two major projects already running. This is the polyol and DCU. And we would like to start the big transformation project, so the first milestone I mentioned, and also we would like to start the projects within the circular economy. So with this financial framework of rather conservative macro scenario, where we calculated roughly with $3.5 per barrel refinery margin, and 350 euros per ton integrated margin. You can see at the bottom of the slide also the sensitivity. So we see a potential uplift of 1 barrel per dollar annually, roughly 100 millions, and 50 euros per ton increase integrated margin will deliver extra 80 million. So with that, I would close the downstream part. Now let me invite Mr. Peter Atatic, who I'm pretty sure will offer you the best coffee ever. Thank you very much.
Thank you very much, Gabriel. It's a very nice introduction. Thank you. Thank you very much for having me here today. It's a pleasure to present to you the update of the strategy. However, as it was already said, it's not a new strategy. It's really an update of that. And now today I can stand more confidently here in front of you to announce that what we want to achieve in the consumer services. We would like to become a digitally driven consumer goods retailer and an integrated, complex mobility service provider by 2030. That's our mission, that's our aim. How we will plan to achieve this? We have three big pillars under this aim. One is to continue to grow on the fuel market, to be the regional leader, and also to grow further on the convenience retailing. In this sense, the fuel is not just about the fossil, but much more than that. The second pillar is the continuous improvement of the operation, of the efficiency, of the processes, everything which is surrounding us. The third pillar is the diversification of the sales channels. We see the opportunities how to grow further and also beyond the fuel network, and I will present it later. But all in all, what we realized, and I am very happy to say that we are more dedicated and confident to make it more sustainable, the entire operation, and even to reach the carbon neutrality by 2030 or even before. If you see on this slide the financial aspiration, the $700+ million EBITDA by 2025 is now on our horizon. How we could achieve this? Well, actually we should continue the past 5 years growth path, and let's do again a 50% total margin growth increase. But even more, the free cash flow generation capability from these segments should grow 85% during this upcoming 5 years compared to the previous 5 years period. From the convenience sales numbers point of view, we should increase 60%. The margin of the non-fuels should even grow further than this 60%. From fossil sales and volume point of view, more than a 30% growth is in our target. And last but not least, probably the most important one is the consumer assumption. We would like to grow further our loyal consumer base from the current 3 million active consumer to 4.5 million, which is a 50% increase. If we have a bit deeper dive into the fossil fuel part, we would like to strengthen further the CEE leadership in this. During the upcoming period, we still believe that a consolidation and the growth would happen on this market. We would like to lead it, we would like to drive it. How we will do that? Well, it's an ambition, but on a yearly basis, the market share should be grown by 1 percentage point. We will increase the quality of the fuel, and our aspiration that in the Central Eastern European market, we would like to become the best quality fuel provider, not just on the premium segments, but also on the main grade segment. We plan to expand further the service network. Well, first let's just talk about the fuel service network. Organically and inorganically, we see good potential on a yearly basis to grow further. Well, but the fossil fuel is not the end of the road. I think beyond the fossil fuel, we cannot avoid, and we wouldn't like to avoid, we would like to grab this as an opportunity to fuel the cars, the mobility on longer horizon as well. That's why we started to expanding the alternative fuel portfolio. During the past couple of years, we dedicated our resources to build up the knowledge, the capabilities. We deployed more than 200 electric chargers on our service stations. And also we plan to expand it further during the upcoming period. However, still we would like to be more cautious to understand where the technology will evolve. Next to the electric vehicles, we also believe that the hydrogen as an energy for the cars will come. Probably not for the passenger cars, but mainly for the buses and the heavy-duty freight trucks. But we also have to start to build up the capability and the knowledge to supply those consumer and consumption needs as well. Here we will have a joint cooperation with the downstream as well, how to create and how to produce green hydrogen for the future mobility. Let's turn the page to probably the most fascinating and most challenging part of the consumer services, which is the convenience offering. Well, as the title says, we will not just focus on the everyday groceries, but the big potential will lay down in the gastro segments of our operation. The 60% increase on the sales side, that's a real ambition and it's a strong ambition. How we plan to achieve this? Well, we certainly should focus much more on the standardization of the methods, of the processes and the assets. We plan to optimize further our OPEX structure to improve the capabilities on the supply chain and stock management. We will strengthen further the standardized gastro and the grocery portfolio offers in all around the retail operation. It's a very important highlight that a few years ago we made the decision that we will not team up with an established FMCG retailer, but we start to build up our own capabilities. Now, after 4 years and to look into the future, I think it was a good decision. We now have the knowledge and the capabilities in the management team, in the expert teams, and I think we can start to harvest it and utilize it further. But the own brand optimization or the current fuel network optimization itself would not be enough to deliver that sales and margin ambition. We need to diversify further the sales channels and expand our operation. The digitalization is a big word. I think it's practically everywhere. We started a few years ago, probably earlier than our competitors in this region. And I think now we have, and we're getting to have very soon, a state-of-the-art, very professional digital platform, which will then help us to make the decisions on a data-driven way. And that will help us not just to optimize our OPEX structure and to make it more efficient, the operation, but also to grow further on the sales side as well. On this digital platform, we were capable to start a completely new reward-based loyalty program. That's what we launched in Croatia, and now the rollout is happening in other countries as well. On the base of these digital capabilities and platforms, the upcoming period's main interest and main focus area will be the personalization. We would like to target much more directly and with a more relevant offers to all of our loyal customers. And also the ambition is to make the non-loyal customers to be more loyal to us. On the back of these learnings and period, beyond 2025, we also have a lot of targets and intention, but we also should start even today to build. For example, the e-commerce, the marketplace operation, but also the standalone fresh corner coffee operation is something what we have already started, and that's what we really committed and we believe in. But also, I think we see a clear opportunity to become a multi-brand franchise operator. We have the customer base, we will have the digital capabilities for that, and also we have a local understanding, a local knowledge on the consumer trends, and last but not least, we have the real estate for that. Well, we said 4 years ago that probably kilometers would be much more important in the future than the liters. At that time, we said that next to the retail, under the consumer service umbrella, the second business pillar should be the mobility services. Well, having 4 years behind us, we are more committed to say that the sharing economy and the new need for the mobility transportation would be more important in the future than probably we earlier thought. You can see that during the past period, we focused on the capability buildings. We started the B2C and also the B2B brand building on the mobility service sector, and also to build up the business model for that. As a result of this, more than 400 million kilometers our customers have already got as a service from us. And that's what we believe that will come more intensively in the upcoming period. Mobility as a service, the utilization of the sharing economy, that's what we will work on during the upcoming 4 years, 5 years horizon, and also the public transportation segments, which is practically the oldest sharing mobility operation. We see the opportunity to penetrate much more onto that market and to get access to a very huge customer base, what was never in the past in our focus. Beyond 2025, again, a step change will come on this. Probably the autonomous vehicles is too early to build up as a standalone business model, but with all those capabilities what we start to build up, I think we will be capable to be the first one who will then utilize the technological advancement on this sector. Well, sustainability goals, as I said at the very beginning, that's become practically the everyday practice in our operation. The carbon neutrality, it's a clear aim. We cannot really shoot anything else just to be a net zero on our operation. By 2030, I think we can make it for sure, but even I have an ambition to make it by the end of this 5 years period. And also the new ambition that the EV cars, the electric vehicles, and all the alternative fuels what we will sell should come from, the energy should come from renewable sources. Carbon offsetting initiatives for the fossil fuels, that's something what we are working on, and I think this year we will announce and we will offer it towards our customers. Conscious waste management, decrease the shrinkage, to use more extensively the recyclable materials in our operation. Those are now our basic ambition and targets from our end. Last but not least, the financial framework for us. Similarly to the downstream and the upstream, we will be capable to finance ourselves. But also I can proudly say that the consumer segments probably will play a bigger, probably a better role in the future in MOL Group's financial position. We plan to become a very significant, almost 50% free cash flow contributor to the group numbers. And you can see that from the previous 5 years period, for the next 5 years period, an 85% free cash flow generation boost should come from this sector. With that, I would like to thank you for your attention, and I'm proudly hand over the word to Dr. Berislav Gašo, who will then present the upstream part. Thank you very much.
So, good morning and welcome to the E&P part of today's Capital Markets Day. I'd like to start off with what you can expect in the next 5 years. And first and foremost, that's a lot of cash. $1.8 billion in free cash flow generation is what we expect to deliver over the next 5-year period. We'll have to put a $1.9 billion in Capex on the table. And that, as I will later elaborate, will put us somewhere between 90 and 110,000 barrels per day in production over that 5-year period. Now, what are the challenges that we will have to tackle, and what are the things that we have clearly prioritized for the next 5-year period? Number one, that's managing decline in Central Eastern Europe. It's there, it's inevitable, we can't run away from it, but we will make sure it happens at the slowest possible pace and at the highest possible unit profitability over the next 5-year period. In international, we'll remain to be opportunistic, as we have been in the past, and that has proven to be a good concept. And on top of that, we will increasingly focus on things like carbon capture, utilization and storage, putting more emphasis on EOR projects, and ultimately, we aim to be net carbon zero by the year 2030, both in Scope 1 and in Scope 2 emissions. Let's talk a little bit about track record. Track record matters. It's an important thing, and I'm glad to tell you basically that over the past 5 years, in 2016, when I stood in front of you, I promised that we would deliver $2.2 to $2.4 billion in simplified free cash flow in a $60 oil price environment. That was the guidance we gave in 2016 in London during the Capital Markets Day. Today, I'm proud to say that we delivered basically $2.4 billion already in 4 years. So the 5-year promise, adjusted for actually for the same oil price, we managed to deliver in a 4-year period. On the right-hand side, you can see unit profitability in different scenarios, and I will probably just pick and highlight 2020. 2020 was a difficult year for the entire industry, but specifically for upstream as well. $42 oil price on average, and 10 euro per megawatt hour in gas price. So an extremely depressed macro environment in which our asset base still managed to deliver $9 on every barrel of oil equivalent that we lifted, $9 in free cash flow. How did we do that? That's the result of efficiency, production optimization, relentless scrutiny when it comes to Capex, and capital expenditure decisions. And since 2016 and until today, we've also managed to tackle basically the reserve challenge that we introduced several years ago, primarily through the acquisition of ACG, which closed in April last year and significantly contributed to our reserve base. So what is our vision going forward? And our vision for 2030? We clearly aim to be carbon neutral as a division, both in Scope 1 and Scope 2. I mentioned that already earlier. That is what we aspire to achieve, and I believe that already today we're on a very good track to achieve that by latest 2030, potentially even earlier. We'll focus on EOR and CCUS opportunities. I'll talk a little bit about that in the upcoming slides. And then I'd like to introduce a distinction on what are we going to do in Central Eastern Europe, which is largely going to be about as efficiently, as productively managing the asset base that we have here, fighting the decline. We need to run very fast just to stand still. We have been able to do that in the past years, and I'm confident that with the track record that we have, we'll be very much in a position to sustain that decline and to slow that decline down as much as possible as we move in the years to come and in the years ahead of us. Simultaneously with that, we'll shift part of the operating model in CEE, and we'll start to increasingly look into carbon capture, storage, utilization opportunities, EOR projects and others. In international, We'd like to improve the quality of the portfolio. We'd like to improve the cash generation. Cash is what we love. Cash is what you love. I've said on many occasions that I love barrels, but I love dollars even more. That has not changed, and that will be kind of clearly also reflected in the quality and in the output and in the portfolio that we would like to see internationally. We'll be very selective on exploration. We're not going to stop exploration, but we will basically selectively look for opportunities that make sense and that are meaningful to us. The base, or part of the base of our strength, is clearly the very, very efficient and robust portfolio that we have in place. We've kept our unit operating expenditures at around $6 in the past. We promise to keep them in the range of $6 to $8 as we move forward, and that's going to be largely a result, again, of efficiency, relentless, continuous efforts to really push down the cost base as much as possible. So that's business as usual. I won't elaborate too much on that. You can expect us to remain very, very disciplined on the cost side as we move forward. So production, where are we going to stand in the next 5-year period? We expect 90 to 110,000 barrels per day from our upstream portfolio. And you can see the decline in CEE. I've shown and highlighted here that this goes down from 62 to 45 to 50,000 barrels per day in the period ahead of us. So decline is inevitable. We will have to do the usual things that we have done in the past: production optimization, cost efforts, cost cutting, efficiency, surface facility simplification, cross-border projects, work on the productivity of our assets, scrutinize basically exploration spendings, and make sure that the things we do really make sense, such as the shallow gas exploration, which was very successful recently. Last year, 7 out of 7 shallow gas exploration wells in Hungary, for instance, have been successful. We want to build on that trend that has clearly added to the strength of our CEE operations, and you can expect things like that to come in the future as well. In international, from 40 will be in a range of 30 to 40,000 barrels per day. So no major change in the composition there. I've excluded ACG and shown that separately, because ACG comes in with the longevity that we always wanted and desired and have materialized with that acquisition. So on ACG, you can expect 15 to 20,000 barrels per day to come over the next 5-year period, and way beyond that 5-year period as well. When you think about ACG, this is largely going to be about delivering the ACE project. The ACE project is a 7th offshore platform that we will build together with the operator and our partners in Azerbaijan. That 7th platform and ACE project will add an additional 100,000 barrels per day stream to the ACG output and sustain basically for a significant time both production, cash flow, and output. So overall, where will that put us? That puts us at $1.8 billion in simplified free cash flow, as I mentioned initially. $1.9 billion is roughly the Capex. There's $200 million additional expenses that we have to put on the table in order to achieve that. So in a very conservative macro environment, and don't forget that this is $50 nominal flat. Today we stand at 65. Yesterday we breached almost through 66. So in a $50 nominal flat environment, we can deliver $1.8 billion. Any $10 sensitivity would add $800 million in cumulative free cash flow on top of that 1.8 that I just mentioned. Few words about the Capex that we're going to spend. 1/3 will roughly go to Central Eastern Europe. Another 1/3 will go to ACG, and then the last 30% in all other international assets. In CEE, we'll do the usual things. That's brownfield investments and redevelopments that we will push forward. We'll clearly push forward with our offshore campaign. We see gas opportunities in Croatia. That's on the plan, and we want to materialize on those. We'll continue with shallow gas offshore, shallow gas onshore exploration in Hungary and in Croatia. That's basically 1/3 of the capital that we will deploy in the next 5 years. ACG, I mentioned already the ACE project. I'm not going to repeat that. That is roughly cumulatively net us $700 million over the next 5-year period. We expect to get $1.5 billion out of that in a $50 oil price environment alone from that ACG contribution. And in international, that's largely going to be about putting more money into Kurdistan, where we clearly see opportunity to grow further the positions that we have. And then, of course, 820, which is the discovery that we have had successfully in Norway beginning of last year. It's a MOL-operated block, which we will appraise this year. If that is working, we'll clearly see an opportunity to continue on that side as well. In terms of CO2 and Scope 1, Scope 2 emissions, you've seen the commitment from my colleagues and the group to tackle the climate challenge. That is clearly also on the upstream side the case. We talk about 0.9 million ton in CO2 Scope 1, Scope 2 emissions that need to be tackled on a portfolio basis in upstream in order to become carbon neutral. Now, we feel that we are very much positioned to address that, given not only that we have significant experience in disposing CO2, and we were among the pioneers in Europe in doing so. We do this more than 30 years in Hungary, where we take CO2 molecules, we inject them in order to enhance the oil recovery and improve recovery factors of existing fields. We do that now for 10, if not even 15 years in Croatia as well. So we have combined 5 decades of experience in disposing of CO2. On top of that, not only as infrastructure owners in CEE, but also as a company with the largest legacy position in terms of mining plots, concessions, etc., we have identified safe potential to dispose north of 70 million tons of CO2. Now, that number might not tell you a lot, but 70 million tons of CO2 would equal 7 to 8 years of total passenger car output emissions in Hungary, disposed of in the earth, additional 5 to 7 years in Croatia down into the earth. Massive potential that we see here. If you would recalculate that number and think about MOL Group's emission upstream, downstream combined, we could dispose for 20 years everything that upstream and downstream is emitting in terms of CO2 into these subsurface opportunities that we see. So we'll tackle this step by step. We'll go first with upstream and make sure that we are carbon neutral. We'll help Gabriel in downstream, and he mentioned that also earlier, with CO2 disposal. And we clearly see beyond that basically even an opportunity for third-party disposal, as we believe that this market will come and there is an opportunity for us to build a strong position in this region. Having said that now, I'd like to hand back the word to József Simola for the financial framework. Thank you.
And you actually saw the financial targets and expectations from the divisions. So I'd like to give you a corporate level summary and also elaborate a bit on the philosophy and some assumptions beyond the numbers. Now, as always, the first starting point is the macro framework. And this is our usual slide, I guess, with a general change that for the next 5 years, we assume a less supportive macro environment, and essentially our previous Brent crude price assumption, which was the $60, we take it back to 50. We also decrease the natural gas price expectation, also refinery margins, leave petchem margins unchanged. And first time we actually introduce explicit price expectations for the CO2 in terms of the ETS prices. Very important to understand that these numbers don't represent our best estimate for the next 5 years. On one side, we don't have the crystal ball for this, and on the other side, that's actually not the objective of this exercise. We wanted to put together a macro framework where we believe that in a normal scenario, that should be actually less favorable than the actual average numbers for the next 5 years, resulting in the outcome you will see later in the Capex spending and other capital allocation priorities, that we should come to the question that we have more money and what to do with it. But generally, we should not come to the question that because of less supportive macro, we don't have money to spend on certain Capex we planned. So again, the objective is to give you a conservative number and give you the assurance that this financial framework should work generally in any macro environment which is coming. Before going to the usual financial parts and the kind of 5-year summary, let me elaborate a little bit on the ETS and CO2. These are actually, other than 22, not new numbers. We published them earlier, but I think this is the first time they are in the main part of the presentation to show how do we think about carbon prices and ETS prices in the upcoming period. As you see, and as you, I assume, expected, that Scope 3 is driving output, which is essentially 90% is the fuel we sell, even actually the fuel we buy from third parties. Scope 1 and Scope 2, 7-8 million. You see it's very much covered, or 90% covered currently by the ETS system. And we expect to remain so. Our price expectations for CO2 is clearly an increase in the current ETS system. From last year average 25, we expect to actually double by 25 euro per ton, by 2025 double to the 50 euro per ton, and actually by 2030 reach the 100 euro per ton level. Now, what does it mean for our financials? That's very clear that nobody knows how the ETS and carbon tax is going to function in 2030. We see actually two parallel factors here. One is, again, as I said, further an expected increase in the ETS prices in the current regime. And we have the 100 euro per ton assumption, which actually seems to be reasonably high, again, of being conservative. But it's also clear if you add up those numbers and also assume potentially an allocation in the quotas, that actually these numbers, which you see that would reflect $6.5 per barrel in the refining and $2 to $3 in upstream. If you compare that to a normal refining margin, these are high numbers. So that's why we believe that actually the carbon tax topic will and have to come on the table in the EU. EU refining versus or ETS tax refining versus Chinese, Korean, and Indian refining. Otherwise, there will be clearly an uneven playing field for the European refineries. We expect the two trends to continue, some ETS type of system remaining, and essentially, I think, forcing the industry to develop and be more competitive, but also a level playing field against the refineries or with the refineries outside of the EU. And we believe that the 100 euro per ton, again, with the Scope 1, Scope 2 roughly equals the ETS, current ETS scope. It's a conservative financial assumption. Now let's go through the EBITDA and then Capex and capital allocation topic. As you see, last couple of years, EBITDA very much driven by macro. And of course, the 20% drop last year is clearly a result of the COVID. We intend to grow from this level, not just actually from 2020, but if we go back 1 year, 2019 level. And our target for next year is the $2.3 billion EBITDA, and we intend to increase this to 2.6 by the end of the 5-year period. Where are the changes coming from? So let's go through in terms of 2020, 2021. And as you see that all the kind of differences or expected differences between the 2 years come from the macro assumption, essentially or assumed macro framework for next year and the current year reality. You may ask, where is the efficiency improvement in this table? And I think the answer to this is that it's around net zero, and 2020 being a COVID year, It's not really a good base year for kind of measuring efficiency improvement. On one side, actually, we have lots of unexpected cost decreases coming from the lower business volumes. But on the other side, we had lots of unexpected direct and indirect sizable COVID-related costs. Now going ahead, it's flat macro, so it's apple-to-apple comparison among the years. What are our targets for the next 5 years? Clearly, we expect downstream projects already being built kick in, polyol and other projects, and delivering a significant contribution to the EBITDA. Expect consumer services growth to continue. Expect net efficiencies, and net is important because we expect headwind, and the 100 should be net with the expected headwind number. And as Barry said, that we are going to have a decline in our production, and that will result in a smaller EBITDA contribution, but all in all, in a growing EBITDA targeted, again, apple-to-apple macro in the next 5 years. So what do we need to spend to generate this EBITDA? The Capex, this is the sustained Capex or stay in business Capex. Our yearly average target is $1.1 billion, representing 2 major factors. With ACG being part of the portfolio, that will result in a yearly 100 to 200 million additional spending compared to the base years. However, we expect in terms of stay in business or other Capex reaching significant efficiency and improvement and reach the same operational results with less spending, and hence the 1.1 billion average target for the next year. Now, where do we intend to invest in a transformation? Essentially, we earmarked $3.5 billion in 3 major categories. Starting from the bottom, 1 billion is the already ongoing and running projects, polyol being the largest, but the Rijeka delayed coker and other projects as well. We have a series of projects pre-final investment decision, very much in line with our downstream fuel to petchem transformation strategy. And for this, we earmarked the $1.5 billion. And as I said before, and this is a new thing, that the $1 billion investment earmarked in the next 5 years in new low carbon and circular economy businesses outside of the scope of the current traditional hydrocarbon business. Now, where does it lead us in overall kind of cash flow overview? This is cumulated 5-year numbers because years will vary, but we believe, again, with a conservative macro, that's a good basis for the overview. Assuming an average 2.4 billion EBITDA per annum, that leads us cumulatively $12 billion EBITDA. The 5 times $1.1 billion stay in business Capex, 5.5. The 3.5 transformational Capex. We usually spend around $300 million a year on interest and taxes. That's the $1.5 billion. And that's actually a $1.5 billion cumulated remaining cash flow before dividends. And again, and I like to emphasize here the importance of the conservative macro, we emphasized, we earmarked $1.3 billion in the next 5 years for base dividend, which is essentially around the current 100 forint per share, $250 million per year level. And that actually leaves us a small positive amount in terms of cash flow overview. Dividend, of course, is a very important topic, and I think this is one of the places where all comes together. You see the previous year's development, and also you saw the integrated financial model. So we very much earmarked and put in our financial model the current dividend level around $250 million per annum as a high priority of the overall capital allocation story. 2 important remarks here. One is that annual dividend, as usual, will be made, or the proposal for this by the board of directors will be made in March, and that will be the same in this year. So you should expect the actual proposal from the board of directors after 2020 coming in a couple of weeks' time. And the other is that what happened in 2020, not really part of the strategy update, but I think you would ask this question anyway. So the board of directors decided an optional buyback up to 5% of the shares in a window of 12 months. This window is open and there is no intention to change this. Up to now, we purchased around 1.3% of the shares, but as always announced that this is optional and in a sense opportunistic strategy where we, I think, were able to take advantage of the very low share price, but they are in terms of no commitment other than this opportunity remains open until the end of the year in terms of continue or not to continue this. And for me, I mean, it then comes all back together in the balance sheet, where based on the previous part of the story, I think it's clear that we don't intend to use the balance sheet for daily operation. Actually, we very much expect that daily operations cover the same business Capex, cover a very significant transformational Capex, provide room for the dividends, and the no need to use the balance sheet. Two remarks here. If you see 2019 and 20, major increase or doubling net debt per EBITDA, but I have to point out that that was the year of the $1.5 billion acquisition and 20% up in the EBITDA because of COVID, and the 1.6 is still at a very comfortable zone and actually going downwards, expected to go downwards in the next year. And that essentially, I think, the final message that, as before, we have a balance sheet to make any strategic acquisitions and any acquisitions in any lines of the businesses where we will seem to fit in the future. So thank you very much, and I like to hand over or back the word to Robbie to lead us up to the Q&A session of this presentation.
Thank you very much, Joska, and actually thanks very much all of you gentlemen for your presentation. So we are slowly approaching I guess the most exciting part of this event, when you can address management with your questions. As a kind reminder that if you want to ask a question, then please use the raise your hand function of the MS Teams platform. But before we go to the questions, please just stay with us and let's watch a short video. Thank you.
The world is constantly transforming. On the one hand, we see amazing technology wherever we look. On the other, we face challenges we've never had to tackle before. We've changed the way we work, move, eat, and tell stories. We've realized what a single person can achieve, but we've also learned how much we need each other. And most of all, we know that the decisions we make today define the way we'll live tomorrow. MOL Group embraces transformation. We want to make a positive impact on people's lives with every step we take. Our vision is to be a key player in the low-carbon circular economy of Central and Eastern Europe. We will become a highly efficient company providing sustainable materials for the economy, low-carbon fuels for mobility, and convenient products and services for the people on the move. In the downstream sector, we are focusing on the highly efficient production of sustainable chemicals, while reducing the exposure to motor fuels and further increasing our profitability. We strive to become a best-in-class digitally driven consumer goods retailer and an integrated complex mobility service provider. In the upstream business, we will maximize the value of our existing assets, become carbon neutral by 2030, and expand operations in carbon capture, utilization and storage. MOL Group wants to improve everyday life. Our energy, passion and diverse talent pool enables us to shape the tomorrow of our company and at the end of the day, drive progress for the entire region. Shape Tomorrow, MOL Group 2030 Plus strategy.